For years, international accounting standards operated under a strange paradox. We had incredibly strict rules for measuring how much a company earned, but almost no structural rules for how those earnings were presented on the page under the legacy IAS 1 standard. Management could leave net profit entirely untouched, yet arrange the intermediate lines to tell whatever story they preferred. They stayed compliant while steering investor attention exactly where they wanted it. This practice has a specific name in financial analysis: presentation-based earnings management. Executives invented bespoke subtotals, hid costs in vague aggregate buckets, or moved expenses outside operating performance. This side-by-side comparison of three identical companies makes the flexibility obvious. When we expand the operating profit row for each, Company A excludes restructuring, Company B leaves them in, and Company C uses a custom subtotal. Hiding volatile items and promoting curated metrics forces analysts to manually unpack and rebuild the income statement just to figure out what actually happened. The legacy rules produced financial statements that passed the audit with ease, but routinely failed to give capital markets a structurally comparable baseline. The International Accounting Standards Board drafted IFRS 18 as the direct regulatory response to this lack of discipline. The board's logic is a major shift in reporting philosophy. Display itself is a site of economic influence. How a number is placed on the page impacts valuation as heavily as how the number is measured. To address this, the standard removes the discretionary formatting of IAS 1 and imposes a mandatory universal architecture on the statement of profit or loss. IFRS 18 rewrites the anatomy of corporate earnings, changing how performance is categorized, totaled, and delivered to the market. Every item of income and expense must now be sorted into one of 5 predefined compartments: operating, investing, financing, income taxes, and discontinued operations. These 5 categories form the unalterable foundation of the new reporting framework. There is no optional zone outside these lines. The most critical shift in this framework requires a complete rereading of the word operating. Investors typically treat operating profit as a sanitized, recurring measure of core business operations. Under IFRS 18, it is not. Operating is strictly defined as a residual category. We pour all economic events into a primary filter. If a massive litigation settlement doesn't meet the strict definitions of investing or financing, it is rejected. It lands squarely inside the operating block alongside standard revenue. If an item cannot prove it belongs elsewhere, it remains trapped in operating, regardless of how unusual, massive, or non-recurring it is. Management loses the ability to silently shift inconvenient costs downward to protect their favored core margin metrics. Standard setters prioritized structural discipline over managerial storytelling. Analysts now receive a raw, mathematically derived operating result instead of a curated narrative. The second structural mandate applies mandatory subtotals that cut horizontally across these 5 categories. These 3 lines create a locked vertical ladder. Every reporting entity must use this exact sequence to show their journey down to net profit. The first rung is operating profit, which universally captures everything trapped in that residual operating category. The second rung is profit before financing and income taxes. This combines operating and investing results to isolate corporate performance completely independent of how the company is capitalized. The final rung is net profit, the culmination of all categories combined. Crucially, management is forbidden from inserting their own custom intermediate subtotals on the face of the primary financial statement. This locked hierarchy grants immediate cross-entity comparability. Analysts can run their screening models directly against the primary statements without spending hours normalizing the data first. Attention remains. Capital markets actively seek forward-looking, alternative performance measures to assess value, and those metrics rarely fit neatly into the strict IFRS 18 ladder. Management-defined performance measures, or MPMs, things like adjusted EBITDA, historically lived in the unregulated ether of press releases and flashy investor decks. Look at the historical divide on this split screen. On the left, we have the audited statutory numbers. On the right, the unstructured management narratives. Instead of banning these non-GAAP metrics, IFRS 18 pulls them directly into the audited financial statements. If a subtotal is used in public communications to express management's specific view of entity-wide performance, it qualifies as an MPM. Once classified as an MPM, it triggers the reconciliation mandate. Every adjusted metric must mathematically map back to the mandatory IFRS subtotals. Inside this single note, management must provide explicit disclosures detailing exactly what was excluded to create the adjusted metric and the logic behind that exclusion. Furthermore, they must disclose the specific tax and non-controlling interest effects for every single line item they adjust. Even the labels are strictly disciplined. Management is barred from using vague terms like other or exceptional unless they provide a concrete, supportable definition. By corralling MPMs into a single note and forcing mathematical reconciliation, IFRS 18 neutralizes the dominance of non-GAAP metrics and forces them into an auditable reality. IFRS 18 moves financial statement presentation from an era of managerial flexibility to an era of structural discipline. We move from fragmented layouts into a rigid, multi-layered architecture. An analyst's eye now moves top-down, beginning with the standard-defined structure before stepping down into management's narrative context. The narrative no longer dictates the structure. The heavy burden of manually standardizing and reverse engineering data across different entities is finally lifted from the professional analyst. Earnings management through display is not entirely eradicated. Executives still exercise judgment in defining their main business activities and assessing materiality. While judgment remains part of the equation, the space available to manipulate user perception is drastically narrowed. By locking down the subtotals and tethering non-GAAP narratives to audited reconciliations, management's view of performance is no longer the main event. It must now stand strictly adjacent to the unyielding IFRS framework.